Hello everyone, welcome to my channel. Don't forget to click the like and subscribe buttons for more articles on accounting and finance. In this tutorial video, I will discuss common practices for reconciling accounts during the year-end process. Accounts to reconcile at year-end in accounting. Importance of year-end reconciliations. Accuracy. Reconciliations ensure the accuracy of your financial statements, which are crucial for decision-making, reporting to stakeholders, and complying with regulations. Compliance. Reconciliations help you comply with tax regulations and accounting standards. They provide evidence of the accuracy and completeness of your financial records. Fraud detection. Reconciliations can help detect potential fraud or errors in your financial records. They involve comparing different sources of information, which can reveal discrepancies. Cash and bank accounts. Reconciling cash and bank accounts is crucial for ensuring accurate financial reporting. It involves comparing the company's internal cash records with bank statements, identifying discrepancies, and adjusting the books accordingly. Common discrepancies include outstanding checks, checks issued by the company but not yet cleared by the bank, deposits in transit, deposits made by the company but not yet reflected in the bank statement, bank charges, fees charged by the bank that are not recorded in the company's books, electronic fund transfers, EFTs, automatic payments or receipts that may not be reflected in both the company's and the bank's records. Accounts receivable, matching sales and payments. Reconciling accounts receivable involves comparing the balance of outstanding invoices to the actual amounts received from customers. This process ensures that all sales have been recorded accurately and all payments have been properly applied to the correct invoices. Identifying uncollectible amounts. During the reconciliation process, it's essential to identify any uncollectible amounts, often referred to as bad debts. This involves evaluating the likelihood of customers failing to pay outstanding invoices. These uncollectible amounts must be adjusted in the financial statements, often through an allowance for doubtful accounts. Ensuring accurate reporting. Reconciling accounts receivable provides a snapshot of the company's outstanding receivables and helps to ensure accurate financial reporting. It helps to identify any discrepancies between the recorded balances and the actual amounts owed by customers. Accounts payable. AP reconciliation involves comparing your company's accounting records to vendor invoices, statements, and other supporting documentation. This ensures that all liabilities are accurately recorded and that payments are made on time. Verify the accuracy of invoices, including amounts, dates, and vendor names. Identify and investigate any discrepancies between your records and vendor documents. Ensure all outstanding invoices are properly recorded and accounted for. Reconcile any outstanding payments or credits related to AP transactions. Regularly reconciling AP helps prevent errors and ensure accurate financial reporting. It also helps you identify potential fraud or misappropriation of funds. Inventory accounts. Inventory accounts, including raw materials, work in progress, and finished goods, require careful reconciliation at year-end. This ensures accuracy in inventory valuation and helps identify any discrepancies between physical inventory counts and recorded balances. Reconciling inventory involves comparing the physical inventory count to the book balance. This process helps determine the value of inventory on hand, assess inventory obsolescence, and identify any potential inventory shrinkage or loss. Fixed asset accounts. Fixed assets are long-term tangible assets used in business operations. They represent significant investments and require careful reconciliation at year-end. Depreciation. Ensure that depreciation expense for the year is accurately calculated and recorded. Capital expenditures. Verify all additions to fixed assets have been properly capitalized and recorded in the correct period. Asset disposals. Review asset disposals for the year to ensure that gains or losses on sale are correctly calculated and reported. Impairment. Assess whether any fixed assets have experienced impairment, requiring a write-down in value. Accrued expenses. Expenses incurred but not yet paid. Accrued expenses represent costs that have been incurred during a period but haven't yet been paid. These expenses are recorded in the accounting system to ensure that financial statements accurately reflect the company's financial position. Examples include salaries and wages earned by employees but not yet paid, interest accrued on loans but not yet paid, rent or utilities incurred but not yet billed, balancing the books. Accrued expenses are recorded as liabilities on the balance sheet, reflecting the company's obligation to pay these expenses. This ensures that expenses are matched with the related revenues earned in the same period. It also helps to create an accurate representation of the company's financial position and earnings. Prepaid expenses. Definition. Prepaid expenses are costs that have been paid in advance for goods or services that will be used in the future. They are considered assets because they represent a future economic benefit. Reconciliation process. Identify all prepaid expenses recorded during the year. Determine the amount of prepaid expenses that have been used up during the year. Adjust the prepaid expense account to reflect the amount of prepaid expenses remaining at the end of the year. Deferred revenues. Deferred revenue represents income that has been received but not yet earned. This occurs when a company receives payment for a service or product before it is delivered or provided. The company recognizes the revenue over time as it fulfills its obligations, matching the revenue to the expenses incurred in earning it. At year-end, companies must reconcile deferred revenue to ensure accurate reporting. This typically involves reviewing contracts, invoices, and other relevant documentation to determine the amount of revenue that should be recognized in the current period. Examples of deferred revenue include advance payments for subscriptions, prepaid services, and deposits for future orders. Loans and mortgages. Reconciling loans and mortgages is essential for ensuring accuracy in the year-end financial statements. This involves verifying the outstanding principal balance, interest accrued, and any payments made during the year. The process typically includes comparing the loan agreement with the company's records, verifying interest calculations, and reconciling any discrepancies with the lender. For mortgages, specific attention should be paid to any property taxes or insurance premiums included in the mortgage payment, as these may need separate adjustments. Additionally, any prepayments or late payments should be noted and reconciled. This ensures the accurate representation of the company's debt obligations and their impact on the financial statements. Equity accounts. Equity accounts represent the ownership interest in a company. These accounts reflect the investments made by shareholders, retained earnings, and other equity transactions. Year-end reconciliations of equity accounts ensure accuracy in the balance sheet and compliance with accounting standards. Examples of equity accounts include common stock represents shares issued to shareholders. Preferred stock represents a specific type of stock with preferential rights. Retained earnings, accumulated profits not distributed as dividends. Treasury stock, shares repurchased by the company. Tax accounts. Tax accounts require careful reconciliation at year-end to ensure accuracy and compliance with tax regulations. These accounts include income tax payable. This represents the amount of income tax owed to the government based on the current year's taxable income. Deferred tax assets and liabilities result from temporary differences between accounting and tax treatment of certain items, which can either reduce or increase future tax liabilities. Tax credits represent credits received for various tax-saving initiatives, such as investment tax credits or energy-efficient upgrades. Tax expenses reflect the total tax expense incurred during the period, including income taxes and any other related tax payments. Reconciling tax accounts involves comparing the company's records with relevant tax documents, such as tax returns and tax notices, and adjusting any discrepancies to ensure the accuracy of financial statements and tax filings. Payroll accounts. Gross pay. Reconcile gross pay with the payroll register and ensure it aligns with employee time records. Verify deductions like taxes and benefits are accurate and reflect current regulations. Payroll taxes. Compare withheld payroll taxes with tax liability calculations. Ensure tax deposits and payments match the liability and are properly documented. Verify compliance with state and federal regulations. Employee benefits. Review contributions for employee benefits like health insurance, retirement plans, and paid time off. Ensure contributions are accurate and reconcile benefit expenses with payroll records. Completing the reconciliation process. Review and analyze. After identifying discrepancies, review and analyze the source documents to understand the root cause of the difference. This step involves comparing the accounting records to supporting documentation like invoices, receipts, and bank statements. Prepare adjustment entries. Based on the analysis, prepare journal entries to adjust the accounting records to reflect the correct balances. These entries may involve correcting errors, adjusting for accruals or prepayments, or recognizing previously unrecorded transactions. Document and archive. Document the reconciliation process by creating a summary report that outlines the discrepancies identified, the adjustments made, and the final reconciled balances. Archive the report and supporting documentation for future reference.